Sarah had been saving money for years in her regular savings account at Chase Bank. She was proud of her discipline, watching her balance slowly grow to $50,000. Then one day, her friend Jake casually mentioned he was earning 260 times more interest than her. While Sarah was earning a whopping $5 per year on her $50,000, Jake was pulling in $1,300 annually on the same amount of money. Sarah stared at her bank statement in disbelief. She had been essentially giving away over $1,000 every single year to her bank. This wasn't some complex investment scheme or risky stock market play. Jake was simply using something called a high-yield savings account, and Sarah's story is playing out in millions of households across America right now. But here's what most people don't realize about these accounts. The great banking deception. Traditional banks have been running one of the most successful scams in financial history, and most people don't even know they're victims. Major banks like Chase, Bank of America, and Wells Fargo offer savings accounts with interest rates so low they're basically insulting. We're talking about 0.01% to 0.05% annual percentage yield. That means if you have $10,000 saved up, you'll earn between $1 and $5 per year. Let's put this in perspective. If you put $10,000 under your mattress and found a penny on the ground every few months, you'd literally be earning more than most traditional savings accounts. Meanwhile, these same banks are taking your money and lending it out at much higher rates, pocketing the difference as pure profit. The reason they can get away with this highway robbery is simple: convenience and ignorance. People choose banks based on location, brand recognition, or because their parents use the same bank. They assume all savings accounts are basically the same, so they never bother shopping around. But this assumption is costing them thousands of dollars over their lifetime. What makes this even more frustrating is that your money isn't just sitting there doing nothing. Banks are actively using your deposits to make loans to other customers at rates of 6%, 8%, or even higher. They're essentially borrowing your money for free and making a fortune off it. But there's something these banks don't want you to discover: the high-yield revolution. High-yield savings accounts are the banking industry's best-kept secret that's hiding in plain sight. These accounts, primarily offered by online banks and credit unions, pay interest rates that are typically 10 to 100 times higher than traditional savings accounts. We're talking about rates between 4% and 5.25% APY as of June 2025. The difference is staggering when you run the numbers. That same $10,000 that earns $1 per year at Chase would generate around $450 per year in a high-yield savings account paying 4.5%. Over 10 years, that's the difference between earning $10,000 versus $4,500. You could literally pay for a nice vacation with the extra interest. But here's what's really mind-blowing: these high-yield accounts are often safer and more convenient than traditional bank accounts. Most are FDIC insured, just like regular banks, meaning your money is protected up to $250,000. Many offer better mobile apps, customer service, and features than the big banks. The only thing they don't have is physical branches, which most people rarely use anymore anyway. The interest rate game. The reason online banks can offer these higher rates is beautifully simple. They don't have the massive overhead costs of maintaining thousands of physical branches, armies of tellers, and expensive real estate in prime locations. Without these costs, they can pass the savings directly to customers in the form of higher interest rates. But understanding how these rates actually work reveals an even more unfair game. Understanding how interest rates work on savings accounts is like learning the rules of a game you've been playing blindfolded. Most people think that when the Federal Reserve raises or lowers interest rates, all savings accounts automatically adjust. The reality is much more complicated and, frankly, more unfair than you might expect. When the Federal Reserve increases interest rates, high-yield savings accounts typically follow suit relatively quickly. If the Fed raises rates by 0.25%, you might see your high-yield account increase by a similar amount within a few weeks or months. This is because online banks compete aggressively for deposits and use competitive rates as their main selling point. Traditional banks, however, play by completely different rules. When rates go up, they're incredibly slow to pass along the benefits to savers. They might increase their savings rates by tiny amounts or sometimes not at all. They know their customers aren't actively shopping around, so there's no pressure to compete. But here's where it gets really interesting. When interest rates go down, both types of banks react much more quickly to lower the rates they pay savers. It's a classic case of heads they win, tails you lose. Rates go up slowly for savers but down quickly when it benefits the banks. What happens if rates start falling again? Your high-yield savings account will likely decrease, but you'll still be earning significantly more than traditional savings accounts. Even if rates drop by half, earning 2.5% is still 50 times better than earning 0.05%. It's like choosing between a sports car and a tricycle. Even if the sports car slows down, it's still much faster than the tricycle. And speaking of speed, let's look at which banks are winning this race. The top players in 2025. The landscape of high-yield savings accounts in 2025 is incredibly competitive, with several standout options that are crushing traditional banks. Current top rates include accounts offering 5.00% APY from institutions like Vero Bank, while other highly rated options provide rates up to 4.66% APY. Marcus by Goldman Sachs has become a household name in the high-yield space, consistently offering competitive rates around 4.5% with no minimum balance requirements. What makes Marcus particularly attractive is the backing of Goldman Sachs, giving savers confidence in the institution's stability. Ally Bank has been a pioneer in online banking and continues to offer impressive rates along with innovative features. Their savings account typically offers around 4.25% APY, but what sets them apart is their complete banking ecosystem. You can easily move money between their checking and savings accounts. American Express Personal Savings might surprise people who only know Amex for credit cards. Their savings account offers competitive rates around 4.35% and comes with the reliability and customer service reputation that American Express is known for. There's no minimum balance requirement and no monthly fees. Discover Bank rounds out the top tier with rates around 4.30% and a suite of additional features. What's particularly interesting about Discover is that they offer cash back rewards on their savings account for certain activities, essentially allowing you to earn even more on your money. These banks didn't achieve these rates by accident. They're actively competing for your deposits because they need them to fund their lending operations. Unlike traditional banks that can rely on inertia and brand recognition, online banks have to win customers through superior products and rates. But the real magic happens when you understand the compound effect. The compound effect. The real power of high-yield savings accounts isn't just in the higher interest rates, it's in compound interest over time. Most people understand compound interest in theory, but they don't truly grasp how dramatic the difference becomes when you're dealing with significantly higher rates. Let's follow two savers, Emma and David, who both start with $25,000. Emma puts her money in a traditional savings account, earning 0.05% annually, while David chooses a high-yield account earning 4.5%. After 1 year, Emma has earned $12.50, while David has earned $1,125. David's already ahead by over $1,100, but this is just the beginning. After 5 years, Emma's account has grown to $25,062, earning a total of $62 in interest. David's account has reached $31,225, earning $6,225 in interest. David has earned over 100 times more than Emma, and the gap is accelerating every year because he's earning interest on his interest. Fast forward to 10 years and the difference becomes truly staggering. Emma's disciplined saving has earned her a total of $125 in interest, bringing her balance to $25,125. David, using the exact same amount of money and the same savings discipline, has earned $13,814 in interest, bringing his total to $38,814. David has essentially received a free $13,689 bonus just for choosing the right type of account. The psychological impact of watching your money grow more rapidly cannot be understated. When you see meaningful interest payments hitting your account regularly, it encourages better saving habits and financial discipline. It's the difference between saving feeling like a chore versus saving feeling like an investment in your future. Yet despite these obvious benefits, most people still resist making the switch. Breaking free from banking tradition. Making the switch to a high-yield savings account is easier than most people think, but there are psychological barriers that keep millions of Americans trapped in low-yield accounts. The biggest obstacle isn't complexity or risk, it's simply inertia and misplaced loyalty to banks that aren't looking out for their customers' best interests. Many people worry about the safety of online banks, but this concern is largely unfounded. Most high-yield savings accounts are FDIC insured, just like traditional bank accounts, meaning your money is protected up to $250,000 per depositor per bank. The insurance doesn't care whether you can walk into a physical branch or not. The process of opening a high-yield savings account typically takes less than 15 minutes online. You'll need basic information like your social security number, driver's license, and details about your current bank account for the initial deposit. Most banks allow you to fund your new account through an electronic transfer from your existing account, and the money is usually available within 1 to 3 business days. The biggest mental shift required is letting go of the idea that you need a physical branch. When was the last time you actually went inside a bank branch? For most people, it's been months or even years. Mobile deposits, online transfers, and ATM networks have made physical branches largely obsolete for routine banking needs. Your savings account should be working as hard for you as you work to earn that money. Every month you keep your money in a low-yield account is a month you're voluntarily giving away free money to wealthy banks that don't need it. The difference between earning $5 per year and $500 per year in your savings might seem small in the moment, but over decades it represents thousands of dollars that could fund vacations, emergency expenses, or even early retirement. The choice is simple, but it requires action. Your money is sitting there right now earning almost nothing, while better options are just a few clicks away. The banks counting on your inertia are hoping you'll never run the numbers and never realize how much money you're leaving on the table. But now you know the truth, and with that knowledge comes the power to change your financial future.